That's not all. Moody's Investor Service, on the other hand, wants that banks could face foreign currency shortages as a result of low oil prices, volatile foreign inflows, and lower remittances. To unpack all of these for us and their implications, the financial and management consultant and the CEO of Flame Academy and Consulting, Mr. Oji Udemezue. Thank you very much, Mr. Udemezue.
Thank you. Always my pleasure to be here.
Good to have you here. Well, first, let me get your own assessment of the Nigerian banking system so far since the COVID-19.
Oh, well, Nigerian banks are doing their best to cope with this situation. You find that anytime you have a crisis in the economy, anytime you have slowdown in economic activities, naturally banks will be affected because the banking sector is a sector that coordinates activities in the economy. Every settlement done in the economy, whether in agriculture, in oil and gas, in manufacturing, solid minerals, they're all done through the banking sector. And they thrive in collecting deposits from these sectors, the surplus sector of the economy, and then advancing credit on the other side. So once activities are low, the intermediation in the financial market will also be low. And mind you, anytime you have economic stress or crisis in an economy, it always dovetails into a financial crisis and vice versa. So we expect that with the COVID-19 adverse implications on several economies around the world, not just Nigeria, we expect that the banking sector around the world, globally, are going to have challenges. How fast these challenges are resolved depend on the local authorities, fiscal policy authorities, monetary policy authorities, and the leaders in this banking sector. So if you look at the Nigerian banking sector, it's borne some kind of swing up and down. When we tried to survive the global financial crisis that bedeviled the whole world in 2009, 2010, we struggled to come off it, and we're doing well until we now had the 2016 recession, which saw asset quality in banks deteriorate seriously. And in fact, the average non-performing loan ratio climbed towards 20%. Then coming down to around 11% last year. And then this year, we saw it coming close to 6%, a single digit. But I'm afraid with this COVID pandemic, we're going back to where we came from. We're likely to cross, from estimations from several experts, we may cross double digit again in non-performing loan ratio for the banking industry, which is not a good news for the sector.
Anyway, that brings us to what Fitch is talking about here.
Yep.
Of course, Fitch is saying that banks' lending will plunge by as much as 2.5%. That's from the 14% that was recorded in 2019. And of course, Moody is also saying that banks could face foreign currency shortages. I guess we'll have to take a short break. And when we come back, we will...
we'll look at Fitch. And then Moody.
Absolutely. These two are projections. All right, we'll take a quick break. We'll be back and continue with this conversation. To stay with us. Thank you for staying tuned. And we're talking about the Nigerian banking sector. And I still have here in the studio with me Mr. Oji Udemezue, Chief Executive Officer of Flame Academy and Consulting. Thank you very much for sticking on.
Always my pleasure.
And of course, before we went on break, we were talking about Fitch and Moody's projections on banks. What do you make of these projections?
Fitch ratings, Moody's, and then Standard & Poor's, and even locally we have Augusto rating. These rating bodies are always looking at either the economy as a whole or some segments of the economy, very importantly the financial sector, to say this is how they see things playing out in the near future based on certain factors in the economy. So they do this around the world, not just in Nigeria. So whatever they say, are pointers to what we expect to see. They are not 100% correct, but they are based on some algorithms, some surveys, some facts fed into some data, analyzed, and then brought out some projections, to say that this is what they expect. So it depends on that sector or that economy to work very hard to avert a dangerous projection or joyously expect a very good thing to happen in the future. But now they're saying there's a drop in credit, which of course makes common sense, because with the COVID adverse effect on the economy, you don't expect credit to grow at the pace it had been. In fact, the net growth in credit was about 40% last year, and it was expected that this year we would do 16%. Mind you, growth in credit given to the economy is a sign that the economy is getting better and better, and that that activities in several sectors are getting the blessings of banks in terms of supporting these projects, whether for project financing, infrastructure provision, term loans and all of that for investing in fixed assets or working capital provision. Even in some cases, also supporting government activities. So from 16% expected this year, Fitch is now projecting a 2.5% growth. So we should even just thank God that we still could expect some growth. Otherwise, the way things are, if you look at the worst case scenario, Nigeria can actually have a serious decline in net credit given to the economy. That is, instead of a growth of 2.5%, we may actually see a deficit if care is not taken. Because many banks, I'm very sure, sure what I'm telling you right now, have actually cut down lending to several economies. But because we have a system that's a bit unstable and skewed to some kind of credit concentration, you might still see some kind of growth because most of the lenders in Nigeria are actually the multinational companies and big corporations who might spring up to activities very soon. You have an economy where only about 400 people in this economy in Nigeria, account for nearly 80% of loans given out at the corporate level. That's very sad. That means the SMEs, the middle class are actually missing in the radar in lending in Nigeria. So, I mean, and we have to begin to deconstruct this situation so that whatever happens, you can see that the economy can actually, have activities in lending and all of that, which are depending on these multinationals. And you also have a case where only about 2% or 3% or 200 million Nigerians keep up to 500,000 naira, in their accounts, which is very sad. So all these have to be looked at. The Nigerian banks with the regulators, the central bank must look at policies, smart policies that can rebalance this situation. And
that brings us to the issue of this cash reserve ratio. Now, yes, looking at this Fitch projections are talking about cash reserve ratio is about 27.5%. Now, is it not time that perhaps the central bank looked into this issue, probably bringing this down?
Very intelligent question, very smart question, but can we actually do this? Nigerian Central Bank has become the sole carrier of the burden of driving economic growth in Nigeria. I don't pity them. Each time you have this monetary policy committee meeting, I pity those 10 or 11 members who have to gather and think about how do we make this country progress. I've said this here several times. Even Central Bank on their own about 2 years ago had, cried that we had got to a point of monetary policy exhaustion. And I can assure you right here and now that we're still pretty much at that level of monetary policy exhaustion. Fiscal policy in Nigeria is doing next to nothing to support this economy. Government, central bank has to do all kinds of abracadabra, magical things, including forcing banks to lend about 65% of their, deposit,
LDR,
out. The LDR ratio of 65%. It's all magical things.
Now, even that one, shouldn't it even be, reviewed, considering that yes, that helped the banks to actually issue out credit, but non-performing loans
are going to climb over time. See what's happening here. The central bank is very concerned about lending in the economy, and they want to drive it. But instead of driving it through moral suasion, they are now driving it through moral and regulatory compulsion on banks. And banks are just, between the devil and the deep blue sea. Because, let me just give a simple analysis here. When you collect a deposit, just without looking at other factors, I know there are other factors that can enable the lend, but for a common man, let's look at it this way. You collect 100 million from a customer. Central bank says you must keep 27.5% of that money with them in a sterilized account with central bank, 27%. Then you must also keep 30% in liquid form. You must not lend with that. That's in what you call the liquidity ratio requirement. What is that already? I don't want to look at other factors, other costs of that fund you bring in. That's about 57%. That must be kept in cash. You must not lend it out. So how come now you come back and say these banks must lend out 65% of this deposit out? That means 65 plus 57 is 100. So they must have to find money outside the deposit they collect from customers.
I actually saw a headline in one of the papers this morning that says that for every 100 naira deposit, about 60 naira is idling away.
I just told you that. I just gave you two now.
Absolutely.
30% liquidity ratio
even if
requirement.
these banks would want to learn,
They have to do magic. And mind you, the major lever, monetary policy tool or lever to bring about liquidity in the economy and allow banks lend is the cash reserve. That's the one that works like wildfire. Once you bring, Nigeria has one of the worst cash reserve requirements in the world. 27.5% is crazy for an economy that needs to support the real sector and enable banks give out loans. It is crazy. Everywhere around the world, even in Africa, in some nearby African countries, you don't have CRR above 10%. That's the way to go. But why am I saying that? I mean, you can see central bank saying CRR should hang at 7.5%, then we bring down the monetary policy rate to 12.5%. That's crazy. If you're actually doing monetary easing, the most important instrument to ease from is CRR. The monetary policy rate is more like a guide in the economy too. And by the way, there are several issues. I don't know if we can discuss it here. How can you have an MPR of 12.5 that is almost the same as your inflation rate? In fact, inflation rate is ramping up to 13%. That means in the economy as a whole, the average interest rate in the economy is negative. You can't bring in liquidity, particularly from foreign investors, in that situation. And they know. But, they are, like I said, they are between the devil and the deep blue sea. They don't know what to do again. So my point is that fiscal authorities must begin to help the central bank to ensure that we have a medium to long-term growth in this economy. How can they do that? First of all, they must roll out policies that must ensure that every item in this country that we can produce locally, that we're able to maximize the production and stop importing them. And all these things about oil and gas, importation of petroleum, we must end that. How do we start some modular refining activities? How can we stop the consumption of imported oil and gas products? Because if we do that alone,
well, the central bank has been advocating backward integration. I mean, we can give it to them.
Like I said, central bank has become both the fiscal policy authority and monetary policy authority. Even the anchor borrowing, I don't blame them. This is a very tough time to be a central bank governor. What is our Minister of Finance doing? What is the whole finance architecture doing? What are we doing to improve infrastructure, to boost local production? What are we doing about electricity? There's no energy supply in this economy. And this is constraining lending by banks because banks cannot open their eyes and give loans to sectors that know are struggling to make profit. You produce an item, you have to almost 30% of your cost is in energy production. I mean, energy supply. You produce your own power, you produce your own road, everything, and you cannot compete with it. So we keep importing and importing. Central bank cannot solve that part of this problem. The government of this country has to find a way to provide electricity, provide other infrastructure that will enable SME growth. Mind you, part of the problem we have in the banking sector is that the banks are always looking at how to make money. And the only viable sector for them to make good money, like we're coming to Moody's assessment of low deposit in foreign, is because the 30% of exposure in the banking sector is in oil and gas sector.
Absolutely.
The loans given out by banks is 30% oil and gas loans. And once you have this drop in crude oil price, banks get their fingers burned. But can they help it? When next you have a rise in oil price, they get in there again and get over-risked. And each time again you have a slump in price, we come back to a place where our NPL ratio will climb up again. So it becomes a cyclical wave that can never stop until we open up other sectors of the economy. We have an export ecosystem that is unpopulated. How can these banks and the central bank populate the export ecosystem? So we can expand export in agricultural products, vegetables, grains, even solid minerals, and all of that. So that you find that banks overdependence on the oil and gas sector to lend and make profit because banks must lend anyway. If you choose not to lend, you're no longer a bank. You must lend. But where can you lend to? And again, I'm coming to what banks must do to enable us to come out of this situation. In case we have 5 minutes again to discuss, banks must drop the lazy banking attitude. By the time I finish what they must do, we'll talk about what central bank must do too. They must drop the lazy attitude towards SMEs. Most of the loans you find in the banking sector, apart from the ones they give to the big corporations, they are all salary-based loans. SMEs who have great projects, great ideas and dreams, get those dreams unfunded. You have trapped talents, trapped dreams, unfunded dreams, because banks are risk-averse when it comes to SMEs. And mind you, no economy can grow beyond what we're doing right now in Nigeria. No economy can develop without a very active SME sector, supported by infrastructure development by government and power supply. Nigeria has the single most important risk to our SME growth, power supply. If it is solved, trust me, there will be more opening for banks to lend. And perhaps the Fitch estimate of 2.5, we can overcome it. So there's a lot banks can do. If I have 5 minutes, I can run through it. But it's very, very critical for Fitch, for Moody's estimation about drop in the deposit. That is based purely on the drop in the oil prices.
Yeah.
And unfortunately, these prices may stay within the region of $45 per barrel in the next 6 to 1 year from estimations. Even though U.S. is struggling with their shale production, but a number of other factors are likely to continue to bring downward pressure on oil price. So we see it at about $40 per barrel today, and it's expected to hang around there for quite a long time. And that's not good for Nigeria, looking at our cost of production and other factors.
Okay, let me take you back to what you said about banks being more exposed to the oil and gas sector. Yes, those guys are saddled with a lot of non-performing, assets
right now.
Yes, so considering this
despite
situation,
unbundling a lot of them,
so
last year.
what should be the way out right now for the banks? A lot of them are calling for a moratorium or perhaps debt cancellation.
Where banks are already exposed to this sector, the only way forward is to apply the best method in loan monitoring and loan remediation to ensure that all loan officers, managers, and so on are on top of their game, monitoring, knowing what to do. Not just going to harass the customer, threaten them to take them to court, but find out how you can wait it out, how you can restructure, how you can handhold them through this whole situation, supporting them in the initiatives they're making to deliver more revenues. Otherwise, it's going to be a long wait. You can't force them into paying you. If they have assets that are not performing, they're not producing and all of that, and you've sunk in, long-term, because this is usually, infrastructure financing loans, maybe to, build a new oil facility and all of that, tank farm. It takes average of 2, 3, 4, 5 years to get these loans repaid. So you can't rush them to pay you, because these monies are tied in long-term assets. You must have to wait it out, work it out with them to find a way to generate revenue. And hopefully, like Nigeria has always hoped, that oil price might tank up again. But if it doesn't, it's a real bad situation.
Now, just a quick one. Would you advocate for perhaps a stress test for the banks?
It's something that central bank already does normally, all the time. If you stress test most banks right now, you find that not all of them are very strong in terms of capital adequacy and asset quality. But it's not just expected. I don't expect central bank to take any rash decision based on those tests. But of course, those tests will enable them know where there are weaknesses and enable them, work with these banks to overcome these weaknesses. Let me just run through, if I have a minute or two, a number of things that the sector must do right now to get us out of this situation. One, risk management by banks must be, strengthened at this point. Banks can ill afford to abuse the lending process at this point. Both the credit policy guide and everything about their lending, the procedures must be strengthened. But altogether, banks cannot afford to also be afraid of lending entirely, because that will affect their profit. Several factors are already affecting their profit in the next 1 year. In fact, I expect to see a lot of profit alarms by the financial service players in next quarter. Like I've said earlier, banks must please become more strategic in the way they deal with SMEs. Several guys in this economy, several people have great ideas, both in IT, in production, agricultural, even in exporting, but they lack funds to this, and we don't have venture capitalists here. Banks are the closest friends they can find, even connecting them to CBN kind of funds. But that's not happening. We need to ramp up activities in SME, because when the SME pie gets larger, banks have more business to do.
All right, thank you very much, Mr. Odemis. Well, let's just hope we get it right and perhaps avoid the ticking bomb.
We keep praying, sir. Nigeria is a great nation. We'll get things done well.